your money's not growing as quickly as inflation. So your banh mi is going to 16 and your money is growing a very, very slow rate. It really depends on the individual investor's risk profile, investment experience, comfort levels to volatility in markets and so forth. So it's income producing investments. Potentially that loan, the interest on that loan is tax deductible. So people talk about passive income from property. It's more realistic to have passive income from shares than property.
Forgot to mention that this podcast is going to be PG. Okay. So no swear words, but we're going to try and have some fun as we learn all about financial planning.
For sure.
About how you can generate extra cash flow using your equity from property, so that hopefully investors, and from any whether they're starting or if they're they're way into building a portfolio. Hopefully they can still learn something out of this from you, and then and just have a bit of fun and enjoying just learning about financial planning.
Fantastic.
Awesome. So if I gave you 60 seconds to introduce yourself, could you tell us about what you do and the problem that you solve for your clients?
Okay. We help clients through their financial planning journey in terms of wealth creation, risk protection, and so forth, so that they can meet their personal and financial goals. So we do it holistically. So we look at all aspects, of a client's financial and lifestyle, well-being, and ultimately, it's to it's for the betterment of their lifestyle and wealth creation.
Would you say that it can be a tricky situation, trying to balance generating the wealth and also maintaining their lifestyle as well?
Their goals align to their lifestyle goals, may it be now or in retirement. It is no point having a strategy for a client when they're not comfortable with it or it does not suit their lifestyle requirements. So financial planning is not an exact science. It should be a very personalized service where each strategy is customized to each client. So every client has different wants, needs, fears, objections, and so forth. So we need to understand the client to be able to create strategies for them.
And what strategies and different vehicles do you usually work with to help your clients maximize and generate, their wealth?
Well, it really depends on their life stage as well. So how we plan for an accumulator, which is someone like yourself, where you when you start work to when you retire, is very different to planning for a pre-retiree or a retiree. So a retiree or pre-retiree would be someone transitioning to retirement, so anywhere from say 55 to 65. And a retiree is someone from 60 onwards. So there are different strategies, and obviously different investments, different super contribution strategies, different tax strategies, different wealth creation strategies for each individual, depending on their, where they are in their life journey.
Awesome.
Okay. But I think today we'll probably be concentrating on clients that are potentially in the accumulation stage, where they're still accumulating wealth, they're building wealth leading towards retirement.
So how can I access the equity in my property to create an investment loan for buying shares, and what are some of the steps involved?
Okay, so if most people that have property or have a number of properties would have equity in their property. So equity is basically the amount that is that is between their value of the property and their loan. So if someone has a $1 million property portfolio or a $1 million property, and they have $500,000 loan, so they have equity of $500,000. Okay, as an example. Before we start, I'd like to give a general advice disclosure. This is by law, I have to do that. So the information that I give today is only general in nature, and please, it's not personalized for anybody. So please seek professional advice before proceeding with any
Awesome. And this for Australia, right?
This is for everybody.
For everybody. Awesome. Okay.
So anyway, yeah. So as I give an example, so a client has $500,000 in equity. Yep. So they can borrow against that. So they can borrow. The bank will lend 80% against their equity.
Yep.
So with 500,000, they can borrow 400,000, and they can use that equity to invest, essentially, or do anything with it. You can buy a car, go on a holiday, but if they invest, if they borrow 400,000 to invest, and if the investments produce income, so it's the income producing investments, potentially that loan, the interest on that loan is tax deductible.
Yeah.
Yep. So that's what makes it appealing. So the loan has to be for the purpose of producing income producing assets for it to be tax deductible.
And so when they take out the equity, what are some of the strategies to help really maximize, generating cash flow for or wealth for the investor?
Okay, so if say for example, I mean most people that own a home, they will have equity sitting in their property if they've paid out a significant amount of their mortgage or home loan. Or if they own a number of investment properties as well, they would have some equity sitting there. Now that equity is untapped. So I suppose the way to leverage, this is called a leveraging strategy. So the way to build wealth is one way is to leverage, which is to borrow to invest. Very similar to buying an investment property, you borrow money to invest and you to achieve capital growth and income. So most people, what they find is that the only thing limiting them is the ability to service the loan. So for example, an investor would have purchased a number of properties or a property, and they're looking to purchase their next property, for example, if they're very property focused. But they're not able to do that because obviously they need to borrow a significant amount to buy an investment property. So on average, in Melbourne, it will be about 700,000. It will be more in Sydney, probably $1 million. And the bank will not lend them the money if they do not meet the serviceability requirements, which is their cash flow. So then most investors will just not invest and just let the equity sit in their property. Now, the other alternative is to use that equity and invest in shares, for example. So because with shares, you don't have to buy $700,000 worth of shares. You can start off with 50, 100, 200,000. So you can start off with a lesser amount, which means that your ability to borrow a lesser amount will enable you to potentially meet the serviceability requirements by the banks.
So are you saying that you can show the interest that you're getting from shares could be used to service another loan?
Well, correct, because, and also the other thing with shares is that I suppose it really depends on which property, which type of property you buy. But most properties will be negatively geared, especially in Victoria. Because the servicing costs of the property will be more than the income that they receive in rent. So it would be negatively geared. Now, to create extra cash flow, for example, say for example you get a loan for 5%. For example, So most investors will be on a 30% tax bracket. Obviously there are higher, higher tax brackets, but let's just say on average a 30% tax bracket. So on that 5%, if they use the investment loan to buy shares, that 5% is tax deductible because the shares produce income. So their whole, I mean, the cost of investing essentially is 30% on the 5%. So you minus 1.5%, 3.5%. So you have to, so essentially the break-even point is 3.5%. Which is, obviously the cost of the loan. Of the interest cost.
So as long as you can make more than the 3.5%, it's better to try and invest. So then that way you're generating more above than what you would have if you would just...
Correct, exactly. On a cash flow perspective, say for example, Australian shares will produce around on average 3 to 4% in dividends.
Yeah.
So if you look at the break-even point, and if you look at the potential dividend yield that you can receive from say shares, and also not with Australian shares as well, you do get imputation credits. So there are fully franked credits from companies such as CBA, the major banks, BHP, Rio Tinto, that pay tax in Australia at 30%. So you get 30% imputation credit as well. Yep. So it is also tax beneficial to invest in shares in terms of cash flow. Because if you, say, for example, invest in a portfolio of shares and all those shares have imputation credits are fully franked, if you're on a 30% bracket, that your income is tax-free because of the imputation credits. Whereas with rental income, you're still going to pay tax. If you are positively geared.
Because of where you're investing in.
Correct.
From the loan that you have.
Correct. Yeah. So let's just say, for example, your break-even point or your cost of investing is 3.5%. You're generating 3 to 4% in dividends, for example, from your share portfolio, right? You're more than likely neutrally or in the medium to long term more positively geared. So you're actually generating extra cash flow. But
then when you positively gear, does that mean then you have to pay a bit more tax then?
Well, correct, but that's where you create extra cash flow. Because with negative gearing, you're actually going backwards in your cash flow. So if you don't get capital growth, you're going backward twice. Whereas if you create positive cash flow, that's where your passive income comes in. So people talk about passive income from property. It's more realistic to have passive income from shares than property. Because of obviously the dividend yield, and generally dividends, which companies go up in time as well. So generally, companies increase the dividends by around 10% every year as well.
So if we flip it the other way, if the property is generating positive cash flow to begin with, so that means obviously the income is above the cost to service the loan. Could you still use that extra cash to then still invest in shares and then still generate further minimize the tax that you're already also still paying? And then generate more cash flow?
Yes, correct. Yes. So I mean, you could have a property portfolio that is negatively geared. And then on top of that, use the equity to invest in shares and create potentially a portfolio or an investment that is either neutrally or positively geared.
Which is more favorable for an investor to start off to have an investment portfolio that results in them being negatively geared or to be positively geared?
It depends on the investor, right? Are they on a higher income or are they on a lower income? Depends on which their marginal tax rate. So it also depends on their cash flow requirements as well. So negatively geared negatively geared investments obviously will impact on a client's cash flow. So if they require extra, surplus cash flow, then a negatively geared investment may not be suitable for them. In that sense. And also it really depends on their goals and objectives. Do they want to create more capital growth? Do they want to create passive income? Do they want to create, a more set and forget kind of investment? So it really depends on, as I mentioned, every client's different. So it depends on their income, their cash flow requirements, what kind of investment strategy they're looking for. It could be a combination of capital growth and income as well. So more of a balanced investment strategy. And also their investment comfort levels. Are they, more inclined to invest in property or are they open to shares, so forth and so on.
So how can I access the equity in my property to create an investment loan for buying shares, and what are the steps involved?
Absolutely. Okay. It is actually it's the same process as getting a home loan. Right. So if you have a mortgage broker, right, or if you have a particular bank that you deal with, all you have to do is go to the bank and refinance your loan. So basically they'll do a valuation. They'll say, okay, now your home is worth, or your property portfolio is worth $2 million, right? then they do a revaluation. Then you apply for a new loan, right? That loan will have to be separate. So if you have a home mortgage, for example, for investment purposes, you need to separate the investment loan to your home loan, okay? Because the ATO wants to see and this is where they're cracking down, where some people have their investment as part of the home loan, which is then how do you proportion the tax deductibility of the interest? So it's better to have a separate loan just for investment purposes, right? So you create a separate loan, right? So the bank will assess you. This is how much you can borrow. Then you decide, okay, I want to borrow X amount, 100K, 200K, invest in shares. That's it.
Cool.
Awesome. And then they'll put that amount into your loan account, and you just withdraw that to invest in cash. And this is where we can help you invest the monies. Awesome. We can actually help you with the whole.
What are the potential wealth creation benefits of borrowing to invest in shares compared to investing only with my own savings?
So once again, it really depends on the individual investor's risk profile, investment experience, comfort levels to volatility in markets, and so forth. So obviously, by borrowing to invest, you're creating extra risk. Obviously, because it affects your cash flow and so forth. This is where an advisor can help you mitigate that risk. So how we do that is by looking at your cash flow, doing a full cash flow analysis to make sure that you have sufficient buffers, even though interest rates go up. A lot of investors don't account for interest rates going up. They project that interest rates remain stable, but that's not the reality, as we've seen over the last 3 to 4 years. So what an advisor can actually help you project an interest rate rise. So in any kind of gearing or leveraging scenario, we always put a plus 2% interest rate. So we actually stress test. The banks do that as well. But we do that, on top of of what the banks do. So we look at plus 2%.
Over how long?
Over the life of the loan.
Okay.
Yes. Nobody can predict.
Yeah.
So we over the life of the loan. So, for example, if the investment loan rate is 5%, for example, which is close to that, we look at your serviceability or your cash flow position at 7% for the life of the loan. So you got to make sure that so we have to be comfortable that in terms of cash flow, you have sufficient buffers. If something did happen. The other thing is we will gear conservatively. So if you can borrow, say for example, the bank says, yes, you have sufficient equity and you have sufficient cash flow to service a $700,000 loan. But we're not going to go and borrow $700,000 to invest. We're going to be very conservative. We will look at your cash flow. We look at, okay, if we borrow $100,000, this is how your cash flow position will look. Even with a 2%. Stress test. If you borrow $300,000, this is how your cash flow position will look. And obviously there'll be default figures like income from shares as well. So obviously we take that into account. So we look at your cash flow position. So, but back to cash savings. So obviously in terms of borrowing to invest, you're accelerating or your investments. So if you have say $100,000 in cash, whereas if you can borrow $300,000. You can still use your cash savings of $100,000 and add to the $300,000. So you are accelerating your wealth creation. And so
for example, if someone's got a $500K loan for their own, mortgage of their own home that they're living in. Right? And they have, let's say, $300K in cash. Right? So are you saying that obviously they're paying whatever interest or maybe even principal, whatever. But whatever that cost is, it might be beneficial for them to take out a portion of the cash, whatever they're comfortable with, right? Because obviously if you take out a portion, that means you're paying more on interest and all that. And then once they take it out, they can then either invest in another investment loan or just put in shares. And depending on how much they're generating there, that if it's obviously more than what they're paying in interest and costs, then obviously it's beneficial because they're getting extra cash flow.
Yes. So say for example, a client has say $300,000 in their redraw or offset account.
Yep.
Okay, so we then go through the process of a refinance to see how much more they can borrow.
Yep.
Yep. So say, for example, they can borrow 500,000. We, in that sense, the 500,000, and depending on obviously the client's income and employment situation. Yep. So if in that sense, we are creating a good loan.
Yep.
From a bad loan in that sense. Yeah.
Yep.
So a home mortgage or is not a deductible loan. Mm-hmm. Yep. So you pay 5%, for example.
Yep.
That's after tax.
Yep.
So you pay your tax first at 30%,
mm-hmm.
then you pay your 5%.
Yep.
So it's costing you more than 5%.
Yep.
Yep. So when you create an investment loan, when you have an investment loan, and if it's for income producing purposes, the interest is deductible. So we consider that
the interest of the investment loan. Right?
Yes.
Yeah.
Correct. It's deductible. Yeah. Say for example, they're comfortable to leave 100,000 in their redraw or offset, just for whatever purposes, right? But what we say to the client is, okay, well, why don't we do this? We take 300,000 out. We borrow 300,000. We take 300,000 from the investment loan, or borrow 500,000 from investment loan. Mm-hmm. Put the 300,000 into the offset and use the extra 200,000 to invest. So then they still have your 300,000 in the offset, but then we have 500,000 to invest. If you know what I'm saying. So we are actually
you're taking out from the investment loan to put into
depends on what you can do. Like say they want to leave 100, we can do 700.
Yeah.
700. So we can borrow 500 with 200,000.
Yeah.
Yep. So just leave 100 in the offset account.
Yeah, but then obviously whatever you're generating in the investment loan or in shares, you're going to make sure that covers the extra interest that you're paying because the loan's loan out.
Or say for example, if they want to use the monies in their redraw or the offset account, they can combine that with whatever they have in their offset in their investment loan. So if they can borrow 100, they took 200 out, create. Yeah.
So let's just say, if they've taken up money to invest,
yes,
how much do they need to make so that they are, generating more cash flow than they were, keeping the money in the
offset account? Yeah. Obviously, that's where how long's a piece of string in that sense, right? So that's where the investments the risk comes in, right? Where that's where you want the capital growth and the income in that sense.
Yeah. So you have to look at multiple, whether over time with capital growth,
correct.
Depending on what the investment loan is doing, correct. Right?
Yeah.
Or if you're investing in shares, how much extra, interest is generating. Correct. That can also help offset all
the income, correct.
Yeah, the income, yes.
That's right.
Okay.
Yeah.
Awesome. I talk to a lot of friends who are essentially in the accumulator stage, as you mentioned. Yeah. And they don't really know how to really maximize their wealth. They just want to save as much as they can, buy their first home, pay it off first, and then only think about investing.
Correct.
Would you say that, if depending on their situation and how well their cash flow is, how well their income is, they could potentially look at doing what you just shared about, taking some of the equity or some of the from their loan, from the offset to try and invest so that they can then use that to, maybe as an example, because I'm thinking of could I use that to pay off the loan faster?
Yes. And
then that way I don't have a big debt, and then I could then use whatever extra cash I have or savings to then invest into future, investments as well.
Correct. So that is also that's called a home gearing strategy. Yep. So where you're actually using the equity in your home to create a portfolio of neutrally to positively geared portfolio to help you pay off your loan quicker. Yeah. Your mortgage. Yeah. Okay. So that is actually a strategy, but it is a long-term strategy. Yep. So initially, as you start out, the dividends. You'll be probably, depending on the interest rates once again, that's another factor, which is what interest rates are at that time. the general aim is to have positive cash flow, to create positive cash flow to help you pay off your mortgage quicker. Yeah, because and from then create once your mortgage is lowering or decreasing, then your equity is increasing and borrowing more. So it's a compounding effect.
Yeah.
Yep. So you're creating you're creating a bigger, correct, a bigger a good loan.
Yeah.
Whilst your bad loan is decreasing.
Yeah.
So, this thing takes time. Yep. This strategy takes time. Yep. So the initial years, you're not going to see much change, but as you go along, that's when you see the real change. So I have clients that using this strategy for the last 5 to 6 years, and some of them have almost paid off their mortgage.
Yeah. What would you say be a good strategy to start off with? If someone's, they've got their own home, would home gearing be a good place to start, or are there other strategies?
Well, look, there's many ways to skin a cat. Yep. I think the main thing is making your money work for you and using the power of leverage. Yep. So, I mean, this is not for everybody, but the people that are struggling to get into the property market, and they could be saving in a term deposit or a cash account. Now, this is how I did it. And once again, this is not the right way or the wrong way, but this is how I did it. Yep. So I actually started in shares. Yep. So I invested in shares, had a margin loan. Yep. And I grew that portfolio to a point where I bought my first property outright.
Yep. Wow.
So it was from day one. So if you look at it, when you get a mortgage or a home loan, you have a bad loan from day one.
Yeah.
For if you invest in shares and have a margin loan obviously is it's boring. Oh, sorry, a margin loan is boring against your shares to invest in more shares.
Okay.
Yep. So instead of using equity in your home, you're actually using shares or cash to borrow to invest more in shares.
Yeah.
Okay. So in that sense, it is a good loan because it is a tax deductible loan.
Yeah.
Right.
And you're generating
correct
positive
income.
Yeah.
Correct. To invest, to reinvest. So you got to use the principles of compounding.
Yeah.
Yeah. So most people, when they buy their first property, they're getting a mortgage.
Yeah.
And the mortgage is costing them post-tax 5% or whatever that the interest rate will be, right? Whereas, so there's many ways to skin a cat, but I suppose, to save up for your first property, the best way to do it probably is to invest your monies, not let it sit in cash or whatever. Yeah. And you can still gear, even though you're investing in cash or shares, you can use a margin loan.
There's a lot to learn. I'm learning. I'm thinking for myself as well. Like, what could I do to generate wealth outside of my business as well?
Yeah.
So how does the tax deductibility of interest on an investment loan work, and what conditions need to be met for the interest to be deductible?
Simply the purpose of the loan will need to be for income producing purposes. If you had an investment loan and you bought a car, that's not tax deductible.
Yeah.
Yep. Or
it has to be generating income.
It has to be generating income for it to be tax deductible.
Okay.
Yeah.
Awesome.
So So and shares do generate income as well. Yeah.
What happens when the shares don't generate income?
I mean, that's where. I mean, shares. There are some shares that don't generate income, but in an overall portfolio, then there will be shares that generate income.
Yeah.
So as long as the overall portfolio has some income generating shares.
That way.
Correct. But say, for example, I mean, this is on a technical sense. If you invested in one share and that share does not generate income, technically it's not tax deductible. The interest is not taxable.
Okay.
Yeah.
Cool. And that's why it's good to have a a portfolio.
Correct.
And
Yeah, and generally, in terms of risk mitigation as well, you want to have a diversified portfolio, right? So, with shares, there are various sectors, various demographics, countries that you can invest in, AI, semiconductors, cybersecurity, miners, industrials, financials. You want to, and each of these sectors have cycles.
Yeah.
Yep. So it's prudent to, in an investment strategy, it's prudent to have a diversified portfolio as to have a concentrated portfolio.
what risk should I be aware of when using my home equity to borrow for investing in shares, particularly in terms of market volatility and increased debt level?
Okay. So as mentioned before, obviously one factor that can fluctuate will be interest rates. Yep. So just be aware, as I mentioned, we do a projection, a cash flow projection based on plus 2% in terms of, so stress testing, which is what the banks do as well. The other risk obviously is markets can rise and markets can fall. So you need to have a long-term investment view. And also you will need, say, this is a gearing strategy is not really appropriate for pre-retirees because they don't have the investment time frame may not be sufficient. You need 7 years plus, especially for a gearing strategy. So we can mitigate the risks in terms of the amount of money that we borrow or the loan to value ratio or the leverage. But yeah, generally you need a long-term investment time frame. So of at least 7 years.
At least
7 years plus.
Okay.
The other risk could be illnesses, injuries, death. So that's where life insurance comes in. Okay. So for us as advisors, we need to ensure the clients have appropriate life insurance cover. Just in case something happens, to cover themselves or their family, especially income protection. Just in case they fall ill and they can't work and they obviously can't make the loan repayments and so forth. So that's very, very important.
So those are some of the risks.
Exactly. Yeah. So market risks, volatility, interest rate risks. Health risks. And generally, look, employment risk as well. But we can't help. That's something that we can't control.
How can a gearing strategy fit into my broader financial plan? And over what time frame is it most effective?
So when we do a projection with a cash flow and retirement projection or asset projection in terms of for a client, we generally aim for retirement. So essentially, because shares are flexible investments, they are liquid investments. So what generally happens with a home gearing strategy is that at some point the clients will pay off their mortgage. That doesn't mean that they have to stop the investments. They can continue those investments up to retirement. They're still leveraging. They're still having the tax deductions and so forth. And at retirement, they can sell down the portfolio and then make super contributions. So it actually is a very helpful strategy if clients do not have sufficient, say, super to retire with, because this you can't do this strategy in super. Right? Because you can't borrow in super. In that sense. I mean, for shares anyway. This gearing strategy is primarily for personal. Okay. In terms of, and you get those benefits of tax deductions and reducing your taxable income and so forth, all towards retirement whilst you're building your wealth. So, and then at retirement, you can then sell down a portion or all of it and make a super contribution. And that's to top up your super at retirement. So this strategy is ultimately a long-term strategy into retirement.
Okay. So, because the people that I meet with, either my generation or people that I network with who are either starting to get into the property investment game, that's something that they can look at home gearing as a way to get their foot in the door,
Absolutely.
to get started, to generate wealth, create better cash flow, and hopefully, be able to be at a way better position when they want to retire. Because that's also, like you mentioned, the plan that you want to start, that you want to aim for. And yeah, I mean, that's good. That's really looking after your wealth and making sure that you're covering, some of the key areas.
Yep.
So which were like to make sure that you are covered when there's inflation. I mean, there's volatility in the market, or was it health? What was the interest rates? Yeah. So inflations.
Yeah.
What your health, your employment situations. So because most people, especially my generation, we're taught to obviously do study well, get a degree, get a stable job, save up, invest in a home, pay off your loan, and save up for retirement. That's the simple plan. Whereas there's so many ways, like in your words, like to skin a cat, to generate wealth, to create better cash flow for yourself. That you can also still have a maybe a better lifestyle. Whether it be in the long term or even short term, depending on how much you have, depending on your situation as well.
I suppose to summarize, in Australia, where we have one of the highest tax rate in the OECD, the developed world, right? Gearing strategies such as home gearing or even borrowing to invest is a very you need these strategies to grow wealth as well as to use the tax ruling to your advantage. Yeah. So it's the higher your income, I suppose most people will be in the 30%. 30% tax bracket is pretty high in world standards, right? So even if you're on 30%, but even for professionals that are on the 45 or 47.5%, these strategies work really well because you're saving on tax. So whatever you save on tax, it goes to your pocket. You're building wealth. You're creating potentially extra cash flow. And you're taking a bit more risk to do all that. Fantastic.
If someone watching this podcast and they've yet to buy their first investment property, right? How much would they need to get started, or to even approach you and to say, hey, I want to grow my wealth. What should I do before they even buy their first investment property? How much would you say they need to have to get started?
You could start with they call it regular investments. So, and regular gearing as well. So there is a strategy where you can regularly gear, where if you add, and there are products out there such as internally geared funds, internally geared ETFs, and so forth, where you don't have to borrow per se, but you're actually investing into an internally geared ETF that's listed on a stock exchange, or an internally geared managed fund, and it's already geared to a certain percentage. So you can choose 50%, 60%, 40%. And we can recommend those kind of investments to clients as well. So you could say, to start off with, you can set aside, invest $1,000 a month into an internally geared fund. And you start off with that, and then potentially when you reach, say, around 20 to 50,000, then you can look at other options, and so forth. But generally, you can start off with as little as regular savings, like a regular investment.
And that's better than just putting into a long-term.
Correct. I mean, if you're young and I mean, look, the thing is, a lot of people complain about or talk about cost of living, right? So, and rightly so. I mean, cost of a char kway teow is like $20 now. So I mean, when did a char kway teow become $20, right? It's just flying noodles. I mean, there's nothing to it, right? So people complain about cost of living. Now, the cost of living affects people that do not invest more than people that invest, because investors that invest, their wealth is growing higher than the cost of inflation. So you look at inflation. Inflation is 3%. You put your money in the bank. You put your money in the term deposit at the moment. You get 3.8%. Then you get taxed on that. You get taxed on 3.8. So your return on equity, or your is 2%, 1%. So your money is not growing as quickly as inflation. So your banh mi is going to 16, and your money's growing at a very, very slow rate.
Yeah.
So when you invest, that's when you want your investments to grow higher than the rate of inflation.
Yeah.
Yep. So especially now with the cost of living at the moment, and with house prices and so forth going up at an exponential rate, this is when you really need to grow your wealth.
Yeah.
And you need to grow it more than 3%.
Yeah. Otherwise, it's just going to be eaten up
Correct.
by inflation.
Correct.
And all, yeah.
Yeah. So investors don't really care about cost of living
Yeah.
because their money's growing more than
Yeah.
the price of goods and services
Yeah.
in the industry. So.
Awesome.
Yeah.
Awesome. Where should people go if they want to know more about you and to work with you?
I'm the founder and principal advisor at Wealth Matrix, so they can give me a call. Go to my website, www.wealthmatrix.com.au.
Awesome.
And just have a chat. We're based in Burwood. Our office is in Burwood.
Burwood, Melbourne,
Yeah, Australia. Yep. So just have a chat, and we can see what we can do. We can help them with. Yeah.
Awesome. So we'll definitely put all the links in the comments, or in the comments below. And if you guys want to speak to Ken and just grow your wealth and not be losing money and not let so many things just bring eat away at your wealth, then definitely give Ken a call. And we'll see you in the next podcast.